So there's likely no more important news story in the world right now than what's happening in Ukraine as Russia invades their smaller neighbor. There's economic impacts are being felt across the globe, and there's certainly a humanitarian crisis developing in Europe as they've seen more refugees leaving Ukraine and going into the European continent than any other crisis since World War II. My name is Kent Kramer. I'm the Chief Investment Officer at Foster Group, and this is our biweekly financial perspectives where we look at what's happening in the world in terms of economic and investment markets and what investors might need to know and any actions they might consider taking. First of all, let's look at the impact on that Russian crisis and the Ukrainian crisis in terms of oil prices. People have wondered why oil prices are shooting up, touching almost $140 a barrel last week. Russia is a fairly large provider of oil to the global market. And the fear, of course, is that these sanctions and logistical constraints come in on Russia, that they'll be producing or able to ship less oil, which will mean the supply of oil worldwide will go down, which will in turn drive the prices of oil up. One of the things to look at in this chart is there are other countries that produce oil and natural gas. Certainly the United States is a big producer. OPEC nations are big producers as well. These producers, OPEC and the United States, can certainly produce more oil and natural gas. For OPEC, it's just a decision to turn the pumps on at a larger rate. There's plenty of oil in the ground that they could pump out. In the past, OPEC have chosen to limit their supply of oil to try to control the price. So things are a little uncertain right now, but they can certainly produce more. The United States, in the same way, could produce more. There's more oil and natural gas in the ground in the United States, but regulatory environment and pricing has caused us to produce a little bit less in the last couple of years. That could change relatively quickly, which could relieve some of the supply shock associated with maybe a shrinking share supplied by Russia. You can see in the bullets on the left that Europe relies on Russia for 25% of their oil supply and 40% of their natural gas consumption. So when you think about what's happening in global markets, especially in Europe, they're experiencing probably the worst of this right now because people wonder, where is oil and natural gas going to come from if the trading partner that they've had in the past, Russia, is unable to deliver? Let's look at the other things that Russia delivers in terms of global commodities, aside from gas and oil, where they deliver a large percentage. Those 17 and 11% we just looked at, they also deliver a lot of precious metals, industrial metals, and wheat. So as those supplies are restricted because Russia would be unable to ship those commodities to the rest of the world, people think, well, that's going to be bad news for inflation, potentially causing prices to rise. But again, these kinds of things can be produced by other countries. It's just going to take a while for those supply chains to be retooled and those countries to produce and be able to export. If you look at the overall size of the Russian economy, what you can see here on the left is that it's a fairly small part of the global economy, even though it's a very large country and one that's in the news quite a bit. In terms of its actual economic footprint, maybe not as big as what some people think. If we look at the size of the Russian stock market, for example, one of the things their investors have been worried about as well, what about the stocks that I own or mutual funds I own and their exposure to Russian companies? If we look at this chart, what we can see is that pre-crisis here, the Russian stock market only represented 1/3 of total stock market value around the world. So if you're a globally diversified investor, the likelihood is you had very little direct exposure to Russian equities. This has been the Russian equity market has actually been shrinking over time. This chart from MSCI shows the share of Russian equities as a percentage of emerging markets. And here you can see that in 2007, the Russian equities were over 10% of emerging markets. Lately, February 28th, 2022, you can see that's dropped below 3% of total emerging market stock market capitalization. So their equity market value has been shrinking over time. This next slide shows that even more clearly when we can see the shrinkage since 2009. You know, Russia's had a series of kind of economic bad missteps. And along the way, those missteps and maybe their behavior on the world stage has caused people to lose faith in them as a trading partner or a place where they'd want to place capital. And you can see that's happened here. It's been so dramatic in the last couple of weeks because of the Ukrainian invasion and the lockup of the Russian stock market, which had actually closed, that those Russian shares, for all practical purposes, are worth nothing today only because people can't transact in them. When that happens, when markets become illiquid like that, index providers like MSCI and FTSE, they have to look and go, well, do we want to include the value of any Russian companies in our measurement of global stock market value? Because really we can't value them if there's not a market where those shares can be exchanged or traded. In other words, there's no active buyers and sellers. So what is a Russian company really worth? No one knows today. So the idea is these index providers, MSCI and FTSE, they're going to remove Russia from their indexes. It likely means that most investment managers, mutual funds and index funds, they're going to be looking to remove Russian equities from their portfolio as well. This will be very difficult to do, again, because there's not a market for those shares right now, but the likelihood is those shares are to reflect a value for those Russian companies close to zero just because of the illiquidity and the uncertainty of being able to trade in those stocks at any time in the future. So what does this mean for a globally diversified investor here in the United States? So let's just take a hypothetical portfolio that represents maybe an investor who's got 65% of their equity investments in the United States, 24% of those in stock market investments are in foreign developed countries, and then 11% of the portfolio is invested in emerging markets companies. That's what we're looking at right here. The idea, again, is remember, Russia is a very, very small part, even of the emerging markets part of the portfolio. So of the 11% of the portfolio, if less than 3% of that is represented in Russian equities, and that's falling even more, if you think about the total portfolio exposure here in a 65, 24, 11 kind of portfolio, the exposure to Russian equities is less than 0.5%. You can see it's less than actually 0.4%. If you're a 60-40 investor, so let's say you're not just a global stock investor, but you also have a diversified portfolio of stocks and bonds, let's say a 60-40, 60% stock, 40% bonds, well, that number gets even smaller in terms of your percentage exposure to Russian equities. Less than 0.2% actually in that 60-40 hypothetical portfolio that we're looking at right here. One other note here as we close is geopolitical sell-offs like this, they are traumatic. They introduce a lot of volatility into the environment, and they certainly get our attention, and for good reason. Again, there's more going on here than economic impact. There's a humanitarian crisis, and we can't help but look at the people's lives who are impacted and feel bad and feel like this is a tragic event and the world would like to solve this and resolve this problem as soon as possible. But we do think, well, what does this mean for my portfolio and how long might these circumstances last? Vanguard put this study together where they just looked at certain geopolitical events in the last 40 or 50 years. And what they are showing here is that while the initial impact of the event during the event itself might be negative, that's represented by those brown parts of the graph showing the negative drawdowns in a geopolitical crisis. The light green and the darker green show what that stock market looks like, the US stock market looks like anyway, 12 months or 6 months or 12 months from now. The 6 months from now is the lighter version. The 12 months after the event is the darker version. So again, once the event is kind of resolved, what happens to equity markets? Well, they went down in the midst of the geopolitical crisis, but as soon as that thing was resolved, 6 months later, stocks were up on an average 5%. 12 months later, stocks were up on average 9%, which is actually right in line with historical equity market returns. So the point of this slide is, yes, things are volatile right now. It's hard to tell for sure what's going to happen with equity markets, but the likelihood is, based on historical perspective, is once the issue is resolved, equity markets will return and begin to return those positive numbers that we're used to seeing in most cases. 80% of the time over a 12-month rolling period, US stocks are positive. That means 20% they're negative over a 12-month period. But for long-term investors, there's a high probability of getting a positive return for those people who stay invested in the long term. One of the people who's become kind of a celebrity, at least someone who's gotten a lot of notoriety in this crisis, is President Zelensky of Ukraine. And I just wanted to close with a couple quotes by President Zelensky, because I think he has shown a nobility, kind of a nobility of character that maybe people didn't expect when this thing started. He is, after all, a former comedian who ran for the president of Ukraine and surprisingly won, and people thought he was really in over his head. In this circumstance, he's shown himself to be anything but in over his head, as he's been able to give voice, I think, to the spirit of the people of Ukraine. And you can see that from these quotes here. I like the second one very much. We Ukrainians are a peaceful nation, but if we remain silent today, we will be gone tomorrow. They're defending their families, their homeland with everything they have. They're showing a lot of bravery in the midst of this. It's our hope that the world political order will put enough pressure on Russia to resolve this problem quickly, to restore the safety and freedom of Ukraine, and for the world as a whole to go back to a more peaceful existence. That'd be great, both on the humanitarian side as well as the economic side. So thanks for watching today. This has been our biweekly financial perspectives. If there's a topic that you'd like for us to address, you can send those questions or topics to any of the contact information you see on your screen. Also, if you'd like to talk with a Foster Group advisor about your personal portfolio, your financial plan, we're always ready to do that. We'd love to get a chance to talk to you at your earliest convenience. So thanks again for watching. We hope we see you in a couple weeks.